morning, everybody. I want to welcome everybody to the Cfo Roundtable for the month. If everybody can look up top in your screen, you'll see chat and Q&A. In the chat area, just to make sure you can hear me, if you could just type in there who you think is going to win the NCAA March Madness, put the team in there. I'd like to know who. If they don't put anything, that means they're not hearing me. You guys are hearing me, right?
Yep.
You got no? Okay, who we got? Oh, come on, Alan. Roll Tide? That's not. But nobody else. Wait, is anybody? Do you see any? There we go. All right, Barry. Barry responded. Barry put Parsippany, though. I don't know what it is. Barry always comes on. He's great. I see here in Michigan we got. Don't know. Okay, well, you're not helping me do my bracket here. A lot of Rutgers people.
What is NCAA?
What is NCAA? Gonzaga? Okay, well, at least people are hearing me. That's all that matters. My goal, Alan, is just to start a fight amongst people. So everybody sees where the chat was that was putting the information up there. Later on during the presentation, if you have any questions, please put it in Q&A because that's where I will be reviewing to see if they have any questions. Please try not to put it in the chat area because people usually just have general conversations on there, so I don't look in there as much. I want to welcome everybody again to the Cfo Roundtable. For those that have attended these before, know the process during the presentation. We will be presenting polling questions for those that need CPEs to ensure that people are listening in. And just to make sure that people do see the polls, because Colleen watches to make sure that things are going right, I'm going to put a poll up real quick. Start the first poll. What is your time horizon? What is the time horizon you believe your company is dealing with on succession? So if you could just answer that real quick, I will leave it open for a minute, and then we'll get kicked off with this month's presentation. And for those that are the presenters, hopefully I don't know if you see the polling results, but the time horizon, we have 3 people said imminent, 5 said 1 to 2 years, 10 said 3 to 5, 5 people said 6 to 10 years, and right now 6 people said more than 10 years. So I want to tell you a quick story real quick before we jump into this. I got a call from one of Alan and my partners the other night and said, I have a client that needs an audit done. And Deirdre, it's the middle of February and they're calling up, they need the audit done now for the past 3 years. And I'm talking with Glenn and I said, so have they ever done this? No, they haven't done this. No, they haven't done this. And I said, well, the problem, Glenn, is that they haven't prepared for the audit for us to jump into it. It's going to take a lot. We can do it, but they have to be prepared for this. And the reason why I gave that moral of the story is a lot of companies don't, let me just close out that poll. A lot of companies don't want to anticipate these things going on, like an audit potentially happening or something going on. And you try and counsel them, and Alan does a lot of this, and we'll talk about it more later on. You try and counsel them on what they should try and plan ahead, and sometimes they don't listen, and that leads into the discussion that we're going to have today, is business exit strategies. Nobody ever wants to think of, the end or what may happen, but you have to start planning for it. And I went on Investopedia last night, and Julian Assange gave me this information. And what is a business exit strategy? A business exit strategy is an entrepreneur's strategic plan to sell his or her ownership in the company to investors or another company. An exit strategy gives a business owner a way to reduce his or her or liquidate his stake in the business, et cetera, et cetera. The concept here, though, is the plan. And that's where we have 3 presenters here today to talk about this area. Everybody knows Alan Sobel. He's the managing partner of the firm. He's an extremely intellectual strategist for companies to help them think ahead of what they want to do. The other 2 presenters that are here today, first one is Brett Deering. I love this designation that you have, and I want to hear more about it, Brett, the Certified Exit Planning Advisor. Brett focuses on assisting clients with merger and acquisitions, One area I found on your bio, which I thought was real interesting, was ESOPs. I think that people don't think about them enough. Brett's experience includes implementing business, financial, and personal planning solutions for business owners, athletes, and corporate executives. Athletes, I didn't see you put up who you thought was going to win the NCAA. Okay.
That's my little secret, but I will tell you, me and John seem to agree a little bit, I think.
Okay. And then Deirdre, I've worked with Deirdre for years. I've known her for quite a long time. Deirdre divides her practice between representation of business owners, their businesses, counseling individuals and families, and advising nonprofits. She advises business owners on the legal and structural issues. The tax attorney always keeps an eye on minimizing the business owner's silent partner, the IRS. She also advises on director and officer liability, including business succession and breakups, which is where that leads us to right now, is business exit strategies. And we're going to open up with Brett. And Brett, let me just start with a question to you: is as the business owners are thinking about exiting, or they may not even thinking about exiting, what's the thing that they should think about first, would you say?
That's a great question. Well, first and foremost, it's great to be here. And I want to thank Alan and Brad and Sobel for the opportunity to just talk about something that's near and dear to my heart. And I think one thing that I see is becoming more and more important to business owners. And so what is the single most thing that business owners should be thinking about? I think more so is dispelling the misnomer. I think a lot of business owners feel that they're going to prepare at their own pace for an exit, and they always feel like they have time. But I will tell you that 80% of the transactions that I've worked on usually go with, hey, I just received a phone call from an interested party that wants to buy my business. I'm thinking about selling. What should I do? And it's unfortunate because when you think about that, I often say in most cases at that point, it's already too late. And so what I would say is, you always want to make sure that your business is prepared. Exit planning is about preparation, and it's about maximizing and efficiencies of your overall business. So it's not just setting up the structure for exit. It's also about making sure that your business is always maximized for enterprise value, and making sure that it's ready when it is that opportunity to exit. So that would be, to me, the one important thing that I think business owners should think about.
And I see that, and if you think about it, and when somebody wants to sell their house, they don't just wait for somebody to come into their house and say, hey, I'm thinking about buying. You may have some people like that. Somebody comes in with a boatload of cash, but if you think about it in your own personal life, you always plan things ahead. And the one thing that we have a struggle with, Alan, I know that you've had this issue with clients that always come up. And the reason that Glenn approached me on this was he has some potential public companies that are looking, his client had potential public companies that all of a sudden are looking at it. And I said, well, it's not that easy. And they literally said, can we just flip an audit around? This is how it was worded to me. So, well, thank you for saying that, because usually I'm the one that says that. So, Deirdre, I imagine that you get the same question from clients also in that way.
Yeah, no, absolutely. I think that the planning is so fundamentally important. And the reason is the advisors that are here on the webinar right now, we can't impact what the sales price is. What the business has done to date will impact what that top line sales price is. But engaging in planning before you get to that point in time maximizes what of that sales price you actually end up getting. It could be decreased because of taxes, or it could be decreased because when you go through the due diligence process, to your point, well, now if they need to have audits done, it's now potentially going to be more expensive than if they'd had them done all along in terms of the information that they have. So I think, doing that planning, it maximizes what goes in your pocket, because you're not going to get that top line number that the purchase price was. It's what are you getting in your pocket as a ratio of that number.
So Brett, going back to just thinking about it first, what should so we have a bunch of people on here, and okay, we pumped the brakes. Everybody said, okay, let's stop for a second. What should the first question that they should either ask themselves, you, Deirdre, Alan? Don't ask me. I ask the question.
Yeah, I mean, I think the first question is, are they prepared, right? The second question is the business sellable? I think a lot of times business owners, because they're successful at running their business and they've been doing it for so long, the differentiation in this whole process is that the buyer is buying their business. And so a lot of times business owners aren't running their business for a potential buyer, right? They're running their business for growth of revenue and for the opportunity to grow the business. And that is a much different, format for a buyer. So the best way for a buyer to look at a business and discount what they don't like and or risk is to discount the value of that business. And so you want to make sure before you even start to engage someone in that process that you've had somebody do some type of assessment of the business, make sure that you understand what are some of the issues, right? Because, we can get into, and I'm getting a little ahead of myself as, going down the process, but as you get into that due diligence process, the last thing is you want as a seller of a business are these, what I call aha moments from the buyer. Aha, you don't have this. Aha, there's this issue. That's when there's the propensity for them to discount that value. So I'd say, leading back to your initial question, the first question that you should ask yourself is my business sellable? And if so, is it sellable for the price that I feel is maximized when it goes to a market or an offer?
Now, a little bit, I want to get to the reality of the value of
Sure.
the business.
Yeah.
I had thought, and I've heard Alan say this one time, it may have been to a client or him and I sitting in his office together, and he said to me, I think that what clients need to ask themselves first is, do they want to sell? Are they ready to not be working?
Great
And
point.
Alan, I know that you've experienced that discussion with people. I don't know if you have any thoughts on that, almost the psychology of it. I know you're not a psychiatrist, but you did go to Wendy's the other day. So.
I do play one on TV every once in a while. And I've often joked that I would have been better off with a psychology degree than an accounting degree. Might have been proved to be more helpful. But Brad, that's a great point. I think that people tend to get caught up in the hysteria of the headlines and all the things that are associated with mergers and acquisitions, and they want to be part of it. And they see, a pot of gold potentially at the end of the rainbow, but they don't deal with the emotional quotient elements of it, the things that are going to impact their lives, their company. And an M&A process is succession process in general, and an exit is very disruptive. So if you don't put the work up front, it's part of the planning process about how you're going to prepare yourself post-acquisition or post-succession, whatever it may be. You're not going to have a successful process in the first place, because I think inherently you start to sabotage the process in a certain degree because you're not certain. And again, I think when you head down this path, you don't want to have uncertainty. Doesn't mean you can't jump off the bandwagon at some point because it's not the right deal. That's different than being prepared to pull the trigger when the offer and the time is right.
So I don't know if Brett, if you were talking about the value and understanding the value, and that's the one thing that I've seen a few times. You talk to people, I call them the golf course conversations, when you're walking down the fairway and they ask you a question that's either a loaded question, can't be answered, or it's just so out there. And I've heard people say a lot of times, oh, no, my business is worth, 43 million. And it's like, weren't your sales 2 million last month? It's like, yeah, but it's just blowing up. So
Is Reddit trending multiple?
What's the multiple? What's your industry multiple? You make change for arcades. How is that possible? But I don't know if that's the biggest mistake is there. I'll say the delusion as to what the possible value is, or if you think there's another, what is the biggest mistake that you think comes about during this process?
Not knowing. I mean, it's great to say, I think, but you need to understand and know. And so that process, takes the opportunity for you to start to engage advisors, right? You may want to sit down and speak with an investment banker and say, hey, what's going on with the industry? What's going on with the market? With a very little bit of what I consider to be initial due diligence by an investment banking firm, they can give you a pretty good idea and a pretty good range as to where the business is worth from a value perspective. So, 80% of the businesses that are up for sale every year don't sell. And a large portion of that is because there's a huge disconnect between what the buyer feels the business is worth and what the actual owner or the seller, the buyer is willing to pay. And so, how do you close that gap? You don't close that gap at the table, right? You close that gap through starting the process of planning. And if that investment banker or the advisor comes back and gives you a number that you're not happy with, well, you have two choices. You can either, think about, kind of coming up with a more moderate value for your business, or you can put a strategy and plan in place to start the process of getting that business towards the number that you think it should exit for. Those are really only your two options. But I will tell you is that you're very limited from an option perspective when you're sitting across the table from a buyer. And I think the one thing, Brad, that I'll share with you that a lot of business owners don't realize is, and I know this is going to sound shocking, but it actually takes a seller money to sell your business, right? So why do you want to prepare and why do you want to have that exit planning in place? Because the last thing you want to do is go through a process where you sign a letter of intent and then go through some more due diligence only to find out that there are issues in your business. And now you've spent, $30,000 to $100,000 in, this whole process, and either you and or the buyer decides to push away from the table. So I think a lot of times buyers go, oh, no, I can negotiate this. It's not, I'm sure that your negotiating skills are impeccable, but what it really comes down to for a buyer is your financials, their ability to generate revenue once you're no longer in the business. And if it's a strategic, their ability to create an accretive transaction where that business as it stands can generate more revenue for them as a strategic buyer.
That's interesting what you said about that. And one of the comments that I've made is to people is anticipate that they're going to find whatever you're trying to hide. I don't care if it's financial. I'm not going to get into legal. If it's legal, if it's employee, labor law, litigation with customers, or if it's labor law, they're going to possibly find the matter. So your best bet is to know what's there yourself, because you don't want to be surprised at the table. I imagine Brett and Deirdre, you've gone through some situations where, you look to your client almost like you're in a courtroom. It's like, I would have liked to have known that before the other side told me about it.
Well, yeah, and Deirdre, I know we've worked closely together, but what I always tell a business owner is, I know sometimes you think you can control this scenario and situation, but in most cases, a buyer in due diligence has 3 or 4 different advisors they're using to do due diligence on your business. They will find out if there's something wrong with your business. They will find out. And so what I often say is the exit planning process is not just about, getting you prepared. That's more of the succession from a net proceeds perspective. The exit planning is about getting your business prepared, right? And so even if there are issues, there may be some that you may want that you can work out before you go to market, right? There may be some that, quite frankly, don't have that much impact on the value of your business. So don't spend or waste time on that, right? Brush it up, put a pro forma together so that when you go through that due diligence phase and the buyer says, well, here's this issue, what you really want to be able to say is, we already know that we have a plan, and here's our plan for fixing it, regardless if you buy our business or not. So that deflates the ability for that buyer to say, well, because we weren't aware of that, we're going to discount the value of your business because we assume risk associated with that issue. And that's really what exit planning is. I mean, it's a lot of things, but it's really being able to kind of figure out what those concerns and issues are that a potential buyer would have with your business, fixing them, and then ultimately getting you prepared to maximize the value so that your LOI price and your SBA price or your sales purchase agreement price aren't like this, right? They're more like this, or they're more like this.
Great. I'm going to put up the next poll real quick. Deirdre, looks like you were going to say something. Let me just put up the next poll. Otherwise, I have people start yelling at me in the chat and in the questions area. They need that CPE. So do you anticipate your business succession will be to the next generation, management, sales of the business, combination of people, or none of the above? So we'll leave it up for about a minute. And it's what we have to remember is I'm sure that all 3 of you have some great war stories of the event or the transaction. But what this whole session is really about, and I think that you all, all three of you evangelize to, is the planning aspect that has to happen. We can tell some great war stories, the deal's falling apart, the success stories, everything. But they wouldn't have gotten to that point if the planning wasn't done. And what I found interesting is Deirdre's on here. I'll give the answer real quick. I want to bring it over to Deirdre. 13% said the next generation, 13% said management, 38% or 36% said sale of the business, 13% or now 15% said combination of people, and 24% said none of the above. 8 people said none of the above. So I'm wondering, maybe they'll just close the business down for those, or they're not going to sell. I joke around, but I always wonder who is going to be the quarterback. Alan, you always say, listen, we're happy to be the quarterback, but we're not going to handle all the matters. Nobody should ever anticipate that they can handle everything, because that's a recipe for disaster too. And usually you think taxes, that's, the effect that comes at the end. But then, Brett, I know that you have comments, or you commented how important tax planning is in the business, and that's where Deirdre generally comes in, right?
Yeah, so I think, there's a couple of things. I just want to echo one of the points that Brett said. As an entrepreneurial business owner, you accept a certain amount of risk in your business. A buyer of your business is unlikely to accept that same amount of risk, and that ends up in a differential of the sales price. So what the exit planning process is at the end of the day is really identifying where those risks areas are, and then looking through the eyes of the buyer as to what you can do incrementally 2 years, 3 years, 4 years in advance to minimize whatever those risks may be. Getting audited financial statements is a prime example of something that you can do to prepare for an exit. And if you're planning on doing that, the cost of doing that each year is less than having to get 3 years done all at once when you don't have the paperwork together. Going back to the tax issues, the way that business transactions are taxed is very, very different. And oftentimes I find that a client goes through the LOI process before they then speak to their advisory team, right? So now they hand us an agreement. They say, hey, I'm going to be doing a stock sale, which is great, within 338 H10 election. Say, well, do you know what that means? Well, yeah, they said it's still a stock sale. I said, well, but it's taxed fundamentally differently if you're selling assets versus if you're going to be selling stock for what you're doing. And that quantifies, again, at the end of the day, what goes into your pocket. So there's tax planning in that area around the sale. There's also, you mentioned that, I think you said 13% were interested in family succession planning. There's opportunities to transfer the business at a low value pre-sale and then recognize more value upon sale. But again, that has to be done in advance. So looking at what might these tax issues be allows an owner to go in with, here's what I'm willing to risk from the share that I'm having, whether it's with New Jersey, with the IRS, in terms of who's going to be their partner in these sale proceeds.
As it relates to planning and that tax issue, and I know Alan and I have encountered this a few times, and it's scary on our end because of what we've been involved in. I'll explain to you, sitting there saying, and Alan's saying, what's Brad going to say? Is he going to say something confidential and that we're not supposed to say? You have a client that says they want to go through sale. Okay, well, your net income is only $1 million, let's say. $1 million, especially during COVID, sounds great. It's only $1 million. They say, but come on, it's more. And Alan and I look at each other and go, how do we know it's more? We've done audit. Well, come on. Those trips I'm taking in business, come on. My wife's been going with me. It's all personal. My skiing, it's this, it's that. Okay. Oh, then the cars and all the stuff. Oh, yeah, those are all this. And, all the personal stuff starts coming up, and then we start sweating. And because we know we filed tax returns previously, taking these as business deductions. I imagine that type of stuff, you try and get that out beforehand because it's going to be found.
It is. And it's actually a way that Brett and I work a lot together when somebody's at the beginning of the process, because one of the questions that you need to ask, if you sell your business, can you support your lifestyle off of the proceeds of the sale, right? You just mentioned maybe $200,000 of tax deductible expenses, right? those aren't going to be tax deductible after you sell your business. Will there be enough cash flow coming out of the sale proceeds to be able to support your business? And if the answer to that right now is no, then to Brett's point, you focus on what the business can sell for. Because if you sell your business for $10 million, but you have a $600,000 a year lifestyle, that's not necessarily going to be sustainable over the long term.
Right. And then we face the concept of should we be amending returns and stuff too. But that Alan had pointed that out to one of our clients one time of, okay, are you ready to retire from your personal life too? Because all these trips that you're taking are no longer there, and country clubs and all that stuff is to your point, you better be getting X% return on your investments to be able to, this endowment that you've created now. So that goes back to the psychology of being able to do it. So understanding the actual sale price, Brett and Deirdre, you both have kind of mentioned this, and Deirdre, I think you mentioned, your return on the sale price. How do you get somebody to understand the true value of their business?
Well, I mean, that's a great question. I mean, I don't think that's up for me. I think what it comes up to is the market and the ability for, myself and a group of advisors to help kind of find what that number looks like. I think that's the hard part, right? Which is for a lot of business owners is that not knowing. But I feel like in most cases where there's a real opportunity to have that impact is in the ability to, once you understand what the market is saying is the value of that business. And by the way, that's very different because it can be contingent upon a strategic buyer who will look at your business differently from a multiple perspective and from a value perspective because of the type of transaction versus a financial buyer or private equity, right? Which is looking at kind of that second bite of the apple, if you will, which is for them to kind of have not necessarily a discounted price, but a lower valuated price versus a strategic, and then have that great exit at the end of 5 years that you'll participate in. And then if you're looking to sell to your management, that's a much different type of transaction as well, because you're not getting that market value, right? You're not getting the value that a strategic's willing to pay. You're not even getting probably in most cases the value that a private equity investor or buyer would pay for your business. And so it's really going to depend on your exit options. How do you want to exit? That you first define kind of what value, top line value is for the business. Secondly is how prepared is the business for a transaction? That's going to, drastically, kind of define what the value is of that business. And then ultimately what Deirdre and I work on is, kind of the tax planning. So I think a lot of times people don't realize is that, for you to do a tax plan or a trust and estate plan before a sale, you need at least 12 months, right? You can't get a value of a business and then turn around 6 months later and sell for, if your tax value is 10 million and you're selling for 30 million, that's never going to stand up, right? So you want to make sure that you give yourself enough time for that value, that estate planning value, to stand up through an appreciation of the value of the business when you go to sell. So those three things in my mind are what define the price of your business. I can't define that. I can help you maximize that. Everybody that's on the camera here can help you maximize that. But what I would say is, the quicker and the sooner you start that process, the better off you're going to be in regards to being able to maximize that value. And that's just kind of the thought process behind it. I don't know if that answers your question, but
no, you absolutely gave me great information and I hope the attendees heard what you were saying is not only do you have to determine when you want to sell this, you have to determine what your goal for the company is post you selling it.
Hey, Brad.
Go ahead, please, Alan.
If I could just interject a couple of thoughts here. First of all, my view is that your company may not be on sale, but it should always be for sale. And what that means is you should be operating your company at all times as if you are going to sell someday. That's what public companies do. That's what institutional companies do. Private equity companies manage the business like it's going to be sold. And entrepreneurial companies have a tendency not to do that. So you can solve a lot of this planning problem if you operate under the proviso that you're going to be sold someday in the first place. The second thing I want to point out or kind of emphasize here with regard to value is not what you did, what a buyer sees your company did yesterday. That's just one factor that they weigh in. They're buying your company for what it's going to be in the future. And so, when you talk about multiples, it's all a function of how the buyer views the growth and the profitability of your company tomorrow and the next day and the next day. And you can drive higher values. And people tend to forget about this. They always focus on EBITDA, right? The earnings before interest, taxes, and depreciation, historical EBITDA. And they don't put enough emphasis on how do you communicate how the company's growth trajectory is going to take the EBITDA to another level. That's at the end of the day, what drives higher value. The opposite is also true. If you're in a market where your business is slowly deteriorating, a sharp buyer is going to look at that and say the value of this company is substantially less because your sales are going down, your profit margins are going down, you're commoditizing your services. So it's all in the function of how you view it, I think, at the end of the day, and knowing what drives value is an important element for any entrepreneur to have. And I agree with Brett, and I agree with Deirdre that relying on advisors is important, but you have a responsibility as a business owner to maximize the value of your business, and doing so means understand what drives value.
Right. And as Brett was saying before, too, what I found interesting is you have to start thinking, too, of what you want the goal of the business to be after you leave, although you're not involved. So if you were a family type of business and you value the employees and you wanted them to be around, you have to anticipate that could affect your sales price. If you're here, just as Alan was saying, my business is always for sale, and any large, private equity that comes in, that's a different value. So that's really interesting. As it relates to, I mentioned the employees, and Deirdre, if you plan on having the employees benefit, is there certain, as part of the sale process, is there certain planning that should be considered?
Yeah, you really have to. So most of my owners upon sale, they want to benefit their key employees, right? Equally, most entrepreneurs have not brought those key employees in as equity owners of their businesses. And honestly, if I was their attorney, I'd probably tell them not to, because if they're not bringing something new to the table, why are you giving them equity? You're paying them a nice salary, right? There are ways to do equity-like arrangements, whether it's through options or phantom stock or something along those lines. And that's very important, because if you want to benefit your employees and you plan for it, they can potentially get capital gain treatment on the sale. If you want to benefit your employees and you haven't planned for it, there is one way for them to get a benefit. They get paid a bonus, and you get to take a deduction. Well, the bonus is going to be taxed at ordinary income rates. It's also going to be subject to additional Social Security tax. That's probably not what you intended when you wanted to share the equity of the business with the people. And sometimes functionally it becomes very problematic. If you're selling the equity of the business, okay, Brett's selling the equity of the business, Alan is buying it. Alan is giving a check to Brett. He's not giving a check to the business. Now he has the business. How's Brett bonusing people? How's the money literally getting to them to do that? It becomes a practical problem as well as a tax problem. So while I do generally recommend for the entrepreneurial clients, again, to be just handing out equity here and there, having equity-like arrangements with the employees does a couple of things. It helps retain them. People get nervous when they think the business is going to get sold. Do I need to look for another job? One of the key things to maximizing your price, Alan, to what you talked about for value, is bringing in a more mature management team, because as an entrepreneur, you may have done everything yourself for years. But if you want to sell your business, the person who's been functioning as your bookkeeper really shouldn't have the title of CFO. Maybe you need to bring somebody else in. And in order to incentivize that person, you might have to share equity with them. So putting a plan in place that looks at how do I sell my business, keep my employees engaged through the sale, and then also keep them engaged after the sale, because oftentimes there's an earnout on the back end. And for you to successfully reach your earnout objectives, you're going to need those 4 people to stay on your team.
Great point, Deirdre.
We deal with this a lot, and especially when we have to go in and help clean up get certain books and records together. And Brett and Deirdre, I'm wondering if you have an alias that you go by, because how often do you get called in for a potential sale or discussion as to sale, but we can't tell the employees? So is there an alias? Do you have like a fake website that people can go to and say, oh, here's a real person, he's office cleaner type of thing? How do you handle that?
It's funny because I had that conversation, what's today, Thursday? I think it was Monday with a client. It's an HVAC company, and there's been a lot going on in that space, a lot of consolidation in that space. And so it's, as Cerity Partners, we're a registered investment advisor. So for a lot of individuals, they look at us as a wealth advisor, right? But what they don't realize is that, most of our partners, have come from consulting backgrounds. And so like myself, I was a consultant and an outsourced COO. So for me, I head up the business owner advisory group. So for me, I am the kind of, not necessarily that alias, but when they look at me, they're thinking about, okay, Alan's doing some trust and estate planning. He's doing some wealth management planning, but so it actually works out really, really well with me. I think it's harder when you get into the investment banker and some of the others. And so a lot of times what will happen is the request of information that, the investment banker may need may come through me, right? Or they may just use a personal, the second thing is they'll use a personal email address because either their assistant or someone is seeing their email. So yeah, there's these little tricks and nuances. Sometimes I'll send out an email that says trust and estate planning. Can you please send the following documents? And that's usually kind of how we start the discussion.
Brad, it's very funny because there are owners of businesses that are institutional sellers. Private equity is one of them.
Oh yeah.
They don't hide behind that. They make their objectives clear. Yet entrepreneurs seem to be very reticent to let people know that at some point, this business may be sold. I'm not saying one is a right or a wrong approach, but it is interesting how the world doesn't fall apart when a private equity owns a business and everybody knows at some point they're going to sell. They seem to thrive just as much as an entrepreneurial company does.
Yeah, I think it's a bit, to your point, Alan, that's a great point. I think it's a bit different because I think everybody kind of understands their model, which is at some point they're going to purchase and at some point they're going to exit. What I think a lot of times for entrepreneurs and business owners, as this person was sharing with me, was, well, my assistant has been with me for 20 years, and they do a great job, by the way. For me to walk in or for them to feel like the business is selling, that would probably shake up their world. Like, what do I do? Do I have a job? And so I don't want to place that stress on that individual. Even though they're going to be equally important to the business after I sell, it's going to be a lot easier for me to have that discussion once we're past it. And so I think for a lot of business owners, because there's a lot of people that don't like change, right? And the uncertainty of change, right? When you're getting a new owner, I think we all kind of gone through that process, right? A new boss, or, you're at a new firm and there's that uncertainty. I think a lot of times the entrepreneur, the owner wants to kind of protect the team from that kind of that stress, if you will. I don't know if that's helpful.
Yeah, absolutely. Brad, you're on mute.
Brad, I think you're on mute.
Oh, thank you. Well, thank you for that. I think I was echoing before, so I'm going to put up the next poll real quick. My biggest concern on succession is, and I'm surprised we don't put up their taxes because, Deirdre, I'm going to ask you a loaded question, but unfortunately, or fortunately, however you want to look at it, January 20th happened, and we don't know what's going on with the tax world. We'd like to predict, but heck, Alan was involved with getting a tax law changed in New Jersey, the bait tax is referred to, and he was worked with the administration and everything on it, and we can't get the tax forms that we need to do the filing that's due, I think, in 11 days. So I'm going to ask you the loaded question of, what are there tax changes that we should be considering? How do you plan or strategize to sell a business when you don't know what the tax law is going to be? What are your thoughts?
So if I had a crystal ball, I'd be living on a beach in Tahiti. So I don't. So with that caveat, I think that there's a couple of things that people need to be aware of. Last year, the government spent an unbudgeted $3.5 to $4 trillion. And our normal budget for the year is about 4.3 is usually the federal government's budget for the year. Brett, I think you had a statistic. We've spent like 136% of the debt that we have or something. And one part of the legislature just passed another $1.9 trillion package. Trillion is such a big number that I just don't think anybody can get their head around it, right? There is one way and only one way that the government raises revenue, and that is through taxes. I can say with absolute confidence that the tax laws will change. How they're going to change is really the question. But here are some proposals that are on the table that business owners need to be concerned about. The first most concerning proposal, increasing the tax rate to 39.6%. And if you have a capital gain of more than $1 million, it is taxed at that rate. So instead of a 20% capital gains tax rate, it's a 40% capital gains tax rate. Obviously, that is a huge potential difference. The others is that, many family business owners, they wish to pass their wealth to their families. Right now, we have an exemption of $11.7 million a person. That's proposed to go down to $3.5 million a person. All of these things make changes. They're also looking at potentially eliminating the basis step up, which changes the capital gain structure. So basically, none of the tax news is good. Oh, and increasing the corporate tax rate. One of the things from a planning perspective, though, if you're getting your sale proceeds in tranches, okay, I got 20 million now, and I'm getting 10 million each of the next 3 years. Generally speaking, you tax that as an installment sale. You pay the taxes on it in the year that you receive it. But what if you know that in 2020, the tax rate is going to be 40%, and in 2022, it's 40%, in 2021, it was 20%. Maybe in working with Alan and Brad, you have the opportunity to say, I'm going to pay all the taxes now at the 20% rate, as opposed to paying at the 40% rate. And you don't have to make that decision until you file your income tax return if you sell in 21 until April 15th of 2022. So you can get a lot of insight into that. So I think looking at when money is coming in will be a very important thing to do.
And Deirdre, if I could just add on two things that, some of them require a little bit more planning, but the form of your entity also may impact the taxes. So, for example, if you are an LLC taxed as a partnership, you don't have the ability to have a stock sale. All sales in an LLC are deemed to be asset sales. And while a buyer usually likes an asset sale because he gets to depreciate the purchase price and write it off over a period of time, a seller prefers to have it as a stock sale because it's all pure capital gain. If you're active in your business, you don't even have to pay the net investment income tax. So there's some benefits to thinking about an LLC that might be better off being taxed as a corporation, S corporation for starters, and then possibly as a C corporation. The other thing is if you have enough advance warning and you know that you're going to sell your business after 5 years, you may want to convert to a C corporation where you can avail yourself of what's called Section 1202, which is a small business stock, which means the first $10 million of your gain is not going to be subject to tax at all. Now, that requires a lot more crystal ball looking forward. But if you have a highly appreciating company and you know that you're going to exit, that's something to do. So again, this all comes back to what we started at the beginning, which is that planning element of thinking about your business.
I just want to touch on a couple of things, Alan, that you mentioned there. So you have an S corporation. You're selling some of your assets and you have a piece of appreciated real estate that you're not selling. If you distribute that to yourself to sell everything else, that creates a gain. So there's a lot of secrets around what happens from a tax perspective, depending on what your business structure is. And unfortunately, I think most owners find them out when, to Brett's point, they've already invested tens of thousands of dollars in the process versus sitting down with your accountant to go through, here's what I need to be able to do. The one other thing that, there's 2 points, Alan, that I often see that business owners aren't thinking about that have significant financial impact that they could work with the Sobel team with. Number one is, if they're a cash basis taxpayer, will there be a requirement for them to switch to accrual? And number two, the net working capital number. I find that there's a lot of confusion around that, which is money you have to leave in your business. those, I think, are some other things that people just need an understanding with their team as to what those things are.
Yeah. And just one more point, Brad. I don't want to labor on taxes, but you're talking about the future tax. And Deirdre talked about one of the proposals that's being bantered around is to raise the capital gain rate for $1 million or more to 39.6%. If you're selling your business, chances are you're going to have a gain of more than $1 million. Now, I'm not suggesting that there aren't some small businesses out there that will be less than that, but $1 million comes up pretty quickly. It's my hope that the administration and Congress will recognize that if they decide to go to that route, and at least carves out an exception for the sale of privately owned or closely owned businesses, because that would be, really, really substantial. You're talking right now almost a 20% differential between 20% and 40% if the rates go up. That's a big, big differential, so just something to think about.
Well, it's either that or they start, they go back to piracy times to find gold and doubloon to fund the deficit. But I think it's the gold and doubloon is going to be the taxes that they're going to be levying. But that's significant. And I imagine if people are on this or people start hearing about this proposal, it's going to start creating a little bit of a hysteria. They're going to change the tax laws. The sky is falling. And people will probably be calling and trying to sell quicker than they should, and they're not planning enough, and they're just going to dive into something they shouldn't go into just to get out to avoid that 20%. Well, I say 20% that mentality.
Well, and Brad, keep in mind, right, law, supply, and demand. If right now prices are relatively high because there's a lot of money on the street searching for deals, if the opposite occurs and everybody starts to say, I want to take advantage of it to accelerate selling, which, by the way, is a little bit difficult to do. I mean, Congress could pass law that makes it retroactive. And so you could be putting your company up for sale and still be subject to the higher tax rate if it happens. But to my other point, which is that if you have a lot of people trying to sell their business, prices are going to go down because there's just not, there's going to be that natural tendency of law and supply and demand. So you may lose that 20% on value.
Right. So I'll run the last poll. I haven't seen many questions come in. If I were to sell the business, I am most concerned with finding the best price, protecting my family and employees, taxes, replacement of lost income. So run that. As you're advising clients or people on selling a business, do you look? How do you set up the game plan? Do you look to see when they anticipate getting out and set the calendar from there? That's what I usually recommend is see what your goal is. When do you want to get out? And then we can work backwards. Or do you see people just saying, let me dive in and start doing stuff and not know when they're going to reach it's like running a race or watching NASCAR going around and they don't know when the laps are going to end. We're just going to start driving, going left, but we don't know when it's over. How do you advise the clients to start the process? What's your recommendation?
So that's great. So start the process with an assessment, right? It's like going to your doctor's office. If you don't know if something's wrong with you unless you go to your doctor's office and they do a checkup. An assessment for a business is the same. But I think from an exit planning perspective, it's not just about the business. I think Alan has touched on it and Deirdre's touched on it. There's 3 key foundational elements to exit planning. It's business planning, which is getting the business prepared. It's the financial planning, which is helping to maximize the net proceeds from the transaction, all the tax planning that has to happen before the transaction and meaningfully a while before the transaction. And then personally, which I think Brad alluded to earlier on in the beginning of the webinar, which is what does life look like for you post-transaction, right? And what is that going to look like? So I think, what do you start off with? You start off with the assessment and you kind of get an idea around what are some of the issues that you're challenged with from a business perspective? What are some of the tax challenges that you're facing? If you don't have a trust and estate plan, if you don't have a will, if you haven't had a formal valuation of your business, all of these components and, factor into the ability to be prepared for some type of transaction down the road. And then personally, what does life look like for you post-transaction? I mean, it's an important question over 70% of business owners have seller's remorse within the first 12 to 14 months after the transaction. So it's real. And then I think the final thing that I would say is that 2021 is going to be a pivotal year for a lot of business owners, especially for those that are on the call that said they have an imminent transaction or a 3 to 5 year transaction, because 2021 will be one of the financial years that will be requested within due diligence. And so buyers are going to want to be able to see how your business rebounded from 2020 and what were some of the strategies that you implemented from a business planning perspective to make your business more efficient, and also to put it further in line with kind of what I consider to be the new business element post-COVID, right? So I think a lot of people realize that business isn't going to go back to the way it was pre-COVID. And there's a lot of transparency. Are you using KPIs? Are you incorporating strategy into your exit plan? These are all things that that buyers are going to want to see when they start to do the due diligence. So start with the assessment. That's going to tell you 85 to 90% of what it is that could potentially keep your business from selling or selling at a discount.
Great. Somebody put in the chat room, I thought it was an interesting comment. William put in, have a plan, a backup plan, and a plan of retreat. So, I mean, some people may word it differently, but it was very interesting when he said that. Dawn had a question. What happens when you want to fund a charitable donation from the proceeds? How is that treated? I know that I don't know if that affects the planning aspect, but Deirdre, I don't know if you have any thoughts on that.
Yeah, so it goes in my favorite lawyer answer, which is it depends. So if you just say, I want to take some of the proceeds and make a charitable contribution, that's great. We do have some folks, though, that are operating B businesses that are more socially inclined for what it is that they're doing. I've had companies that have set up charitable foundations that continue their social enterprise, even though the company is designed to be exited, so the social enterprise will continue to be able to do things. So there's a question both from a tax perspective, but going back, Brad, to what you said before, what are you looking to achieve at the end of the day? And then structuring something that's able to achieve those objectives as a business owner.
And if I can add another thing to that, Deirdre, because everything you said is spot on, but there are some planning techniques as well, like to not use after-tax proceeds to make the contribution. You can actually, like you can today, you can give appreciated stock away. You could do that in a closely held business situation, but it requires a heck of a lot more planning because you're essentially giving a charity stock in your company that's ultimately going to sell, or you're giving it to a trust of some sort. So there is some planning opportunities to reduce the tax impact beyond just taking the after-tax proceeds and giving it away. But it does require a lot of thought and a lot of planning, and it has to be significant enough for it to really be worthwhile to invest in the professional fees to do that, because it's not inexpensive to go through that process.
And I know that we're talking about planning, and this question actually is going to be about planning. Have you ever had a situation happen during the process, the sale process, that you can share that had they thought about this in planning, we could have avoided this? It's like the old Woody Woodpecker thing. Had Woody gone to the police, this would never have happened. Do you have a story that you can share just so people understand these are the type of things that happen? And I know I'm like surprised you with that one, but I will give one where the client, and usually we see a lot of financial, but the client had a situation where had they reviewed their employee records properly, they would have the buyer found issue with the employee's records and stopped the deal completely because they didn't want to inherit this situation. And had they gone through and really reviewed their employee records beforehand as part of their business process, they would be sitting on the beach right now.
The biggest one that I see is not having assignment provisions in your contracts. So you enter into a contract with somebody and you can put it right in there that I'm allowed to give my contract to somebody else. And that's what you need to do if you're selling your assets, which Alan made a point before is how the majority of deals end up being structured. If you if you go to your best customer and say, you know what, I never put an assignment provision in this contract, but, can I put one in there? If I'm your best customer, I'm going to want to know why. And I may not want to continue to be your best customer because I may not be interested in working with who it is that you're going to be selling something to. I've had a number of transactions that, for failure to put a paragraph in standard contracts, don't allow the sale to take place. The other is with your landlord. If you need to sell if you need your business to go with the sale and you don't have the ability to do that, your landlord can veto and hijack your entire sale. So it's when you're entering into the contract, making sure that you have all the provisions in there so that when you want to exit, you can exit. And that's a low cost thing to do. You get one standard contract, you use it over and over again, as opposed to what Brett was talking about before, where it's very high cost to fix things as you're trying to get to the closing table.
Yeah, I mean, I think there's, one after the close, which is a tax scenario where we, we're really harping on, to this client, probably about a year and a half. I was working with this client about a year and a half before the transaction to get a valuation, a trust and estate valuation, so that we could do some of the trust and estate planning for the client. They dragged their feet and ultimately got into a situation where there was an interested strategic buyer, and they weren't able to, actually create the valuation and the trust and estate planning before going into kind of an LOI situation. They came out on the other side with a pretty dramatic tax bill based on the scenario, because what happened was the business over the course of that year and a half did extremely well. So there was appreciation in the overall value of the business, which drove up the price. And then ultimately the fact that they didn't have trust and estate planning from a tax perspective also drove up the tax obligation. So that's one issue that I think a lot of times business owners think, oh, it's great, but I can tell you that client was not happy when they saw their tax bill. And even though that was coming out of the proceeds, it was just a big number. And, that's one of those situations where you feel badly about it. But ultimately, I think the other is where there are issues, where if they don't have employee contracts for their key employees, some contracts, some employees may cut out the back door. And if you don't have that contract, they may actually start a business with one of your clients. And so for a buyer, that's a no-no. And so I had that situation where, really fundamentally good business. Ultimately, it seemed like, the COO had, aspirations of starting their own business, had a very detailed list of clients, very detailed list of work in progress, stepped in between the transaction and their customer base, because there was no non-compete. There was no employment agreement to stop that. And the buyer said, there's no way that I'm buying the business because it's too disruptive. This whole process is too disruptive to me being able to, to run the business post-transaction. I mean,
they say that, the way you win negotiations is having the, leverage in a situation.
Yep.
Well, a key employee who knows the business is being sold and doesn't have a contract has leverage. And that definitely can be very disruptive to the process. And they can hold they can hold the owner over the barrel with a lot, tremendously in that process. So that is a type of deal.
I've seen a salesperson actually have them retrade a transaction because they wind of the sale and basically wanted equity in the business and had to cause them to reshuffle the equity stack and retrade the transaction. These are things you don't want to do with a buyer when you're, when you're in exclusivity after signing an LOI.
And a lot of people always say, no, it's going to go fine. It's going to go fine. We don't need that. It's never, Alan, you say this all the time, it's never a problem until it's a problem. Okay. Anticipate there's going to be a problem. Wendy asked, and you're going to appreciate this, Deirdre, I think I know your answer already. Okay. Funny, we give a similar answer too. Does small lawsuit impede the sale of a company?
Yeah, well, it depends.
Huh?
It depends.
It depends.
Is it a small lawsuit with a wage and hours violation? Yeah, you're going to have a problem with that. Is it a small lawsuit over a contract, so there's a cap on it? But generally speaking, when you sell your business, you should be prepared for there to be an escrow of some amount, which is against these potential liabilities. So if the sale price is high enough and it goes back to what Brett said before. If the buyer can quantify the risk clearly enough, then it goes against the escrow and it's not a problem. But if you have a wage and hours lawsuit, which tends to be the beginning of a series of employer-related lawsuits, that makes your company very unattractive. But there's a lot that you can do to prevent that easily. Brett, for your situation, if the company just has a standard policy that every person coming in signs an agreement, problem solved, right? Brad, for your situation, if you actually review your records once a year, your employee records, you can fully avoid that. And it's expensive to fix these problems, particularly from a legal perspective. But in terms of when we're looking at planning, if you have in-house HR people, CFO, et cetera, it costs you basically nothing to do things every single day to prevent these problems from happening because you're already paying these people to do things. So that's what I would really like folks to take away from this is what can I do? And Alan, I love your quote, to have a business that is always for sale if I'm not actively selling it. I think that's just a brilliant way of encapsulating all of this.
Right. So, and it's funny what you just said. It harkens back to Disney World. And I was talking with the maintenance guy there one time because I talked to everybody, and he said we change light bulbs routinely. And I said, well, don't you go in there out? They said we don't want to go when they go out because that's more expensive and more timely. It's easier for us to just maintain them and change them regularly. Plan your business, work on your business. If you have that CFO, if you have that HR person, have this as part of their process. Right before closing, because I see we're at 9:30, somebody just put up a question. Alex says, if you use independent contractors in your business, you need to be sure they're fully independent contractors, not employees. Okay, so it's more of a comment. Absolutely, Alex. You should really have somebody review your employee situation before selling. I absolutely recommend that. So what I usually like to do at the end, we're at 9:30, is ask if you have closing comments, some parting wisdom. And I'm going to have Alan go last, and I'll say why before I have him go last real quick. But Brett, do you have any parting comments for everybody?
Yeah, I would say that transparency into your business at this point is key. And, getting an assessment isn't going to allow you to do that. But starting the conversation with advisors early on in this process, I can't emphasize that enough, because quite frankly, the only person that ends up paying at the end of the day, if you don't do it, is you, not us. We can help you if you engage us, but if the cake is already made, we can't. There's not much we can do. So have an assessment, engage, and learn more about where the potential issues are or challenges in your business. And I think you're going to find that successful planning process and starting that is going to lead to more successful opportunities for you in the future, even if you decide to exit.
Great comment. Thank you. Deirdre?
Yeah, I'm going to echo that. The folks that I know that have had the most successful exits, well before they were even thinking about who they might sell to, they put a team around them of people that they knew. You didn't ask the poll question of how often these business owners have sold their businesses, but I'm going to guess that most were 0, maybe some were 1. If you've never gone through this process before, how do you know what it is that you're supposed to do? And this is not a time to be learning on the job. So having that team of advisors, so if you do get a great offer, you've already thought about these things. And again, if you already have these relationships, it doesn't cost you to have conversations with somebody. Here's some things about my business. What would you think about if I was doing that? So cultivate those relationships and that team now.
Great, thank you. And before Alan makes his comments, I want to thank everybody for coming today. And I would like for everybody to know that Alan is selling a birthday very soon. So everybody, not just here, should make sure that they reach out to Alan to wish him a very happy birthday. So with that, Alan, do you have any closing comments?
Thanks, Brad. I appreciate that. Yeah, it's one of those milestone birthdays that I'm not looking forward to. But I commented the other day. Brett has a picture behind him of his nephew, who's a Marine, And I'm reminded of when I was in college many years ago, of a fraternity brother of mine when I was pledging, who taught us about the 6 Ps. And I think that's something that's taught, that the Marines talk about. And it's, excuse my vernacular, but it's prior planning prevents piss poor performance. And I think if there was a message that really was conveyed by Brett and Deirdre here today, it was that if you plan well for succession, and succession may lead to an exit, succession may lead to an internal orderly succession in your business without a sale. But if you plan for succession the right way, you will prevent bad performance. You will have good outcomes. And so that's really it. Make it part of your business strategy. You have strategies to how to increase your sales, how to create greater operating efficiencies, how to buy product better. Incorporate in there the succession of your business, and you will have a much more valuable business at the end of the day if and when you decide to exit.
Great. I want to thank the presenters very much. Their information is available on the site. I recommend you reach out to them and start talking, start the process. Doesn't matter if you're planning on selling, tomorrow, but it'll help if you're not. But if you plan on selling in 10 years, it's important that you start the process. So, Deirdre, Brett, Alan, thank you very much. The information was really informative, and hope you have a good day. Hope the weather turns out warm and we can start going outside.
Take
Thank
care.
you so much.